Excellent, excellent. Well, welcome everyone. I'm delighted to welcome our next presenter to the stage. Jay Ninsmeyer is a renowned maritime shipping analyst who directs the Value Investors Edge, VIE, research platform on Seeking Alpha. He's a frequent speaker at industry conferences, is regularly quoted in trade journals, and hosts a popular podcast featuring shipping industry executives. Mr. Ninsmeyer also hosts regular virtual investor forums, which are must attend for anyone interested in the shipping and infrastructure industries. Jay, it's a pleasure to welcome you. The stage is yours.
All right, fantastic. Thank you very much. It's great to be back at another Money Show. And thank you for everyone who decided to tune in with us today as well. I'm the head of research at Value Investors Edge. We've been around for about 6 years formally. We're hosted on Seeking Alpha, but what we do is we offer research either by the month or by the year for investors, researchers, hedge funds, family offices, anyone who wants to learn a little bit more about the shipping space or connected logistics and energy stuff. I'm on Twitter. You can follow me at Ninsmeyer. I have some free market updates and stuff I do there. We also have 2-week research free trials available at my website below. Those will be available through tomorrow. We only offer those about once a quarter. So this is the kind of the 1-week window where we're doing this conference. So one thing I wanted to open up with, hopefully a little bit of an attention grabber. We've been partnered up with Money Show for the last about 1.5 years, and I do these about once every quarter. And each quarter, I talk about the shipping industry, and we offer some actionable picks for free, just for folks who join us here on the Money Show. These recordings are available on the Money Show and as well as my own YouTube channel. So you can go back and see the previous presentations and see the previous picks I gave and all that sort of stuff. But just as kind of an appetizer here, we first came on last August and talked about the outsized return potential in maritime shipping. The average return of those picks in 4 months, and the reason it was in 4 months is because that was when the next Money Show was at. So that return was 38.5% in 4 months, which outperformed the S&P 500 by 26% in those 4 months. That's an outperformance I'd be happy to have in a year or two, but we definitely got a lot of tailwinds on our back. Then December we came on, outsized post-COVID recovery potential, 38.8% return in 4 months from those picks. Then we came on in April, riding the global economic recovery. 16.2% return in 3.5 months, which again, 8% S&P 500 outperformance, slowing down a little bit, but still a pretty big outperformance in just 3.5 months. And then finally, our last session was this summer, 27 July, maritime shipping. We said it'd be the hottest sector for the rest of 2021 and into 22. And the average return of those 5 picks was 36.8% in 3 months. So again, outperformance there. S&P 500 was almost flat over these last 3.5 months. It only went up about 4%. So I can't promise, I mean, obviously past performance doesn't guarantee future results, but we're going to have some top picks again. And we're batting 4 for 4 pretty strong here. So hopefully that'll get your appetite up as we go through the rest of the presentation. So today we're going to talk about our background, our focus, how we approach the market, and what helps us outperform in this sector. We're going to briefly review kind of what happened with COVID and how those stocks have recovered since. Then we're going to look at year-to-date stuff. Then the main course is we're going to talk about the most attractive sectors today. We're going to cover container ships, dry bulk, tankers, and LNG. A lot of meat there, but we'll try to keep it concise and helpful for you, keep it actionable. We have a top pick in each segment. And then finally, I'm going to try to leave 5 minutes, hopefully 10. We'll see how the timing goes for some Q&A. Q&A is usually the most engaging and fun part of this presentation. So if you think of something along the way, feel free to jot it down in the chat, post your question there, and I'll be happy to take as many questions as I can. So first of all, our approach to the market, how do we outperform? We only stay in our lane. We don't do anything else outside of maritime shipping or related trade infrastructure. I have a team of, there's a team of 4 of us. James Catlin, he's our main macro guy. He works in conjunction with helping me decide which cycle, where the cycle's at in its stages, what sector is the most attractive. All right, Jay, we need to be careful because this new order book is building up or this new project got delayed. He's very helpful with that. Michael Boyd does all my energy and infrastructure stuff. He's helped me a lot with U.S. export infrastructure development, letting me know what the timelines are, letting me know of things to watch. He's helped us very recently too with getting ahead of this energy cycle. Things like Diamondback Energy and Cosmos, which tie very closely into our shipping focus. And he's been well ahead of the curve on that. And finally, Clement Mullins is our associate analyst who focuses only on maritime shipping. So as you can tell, we are very focused in the market. I believe my thesis is that because of this focus, and because of the rigor that we bring to the market, that's led to the outperformance you see below you. These are unaudited figures, but these are representative of our top picks and our model portfolios going back to 2016. We do monthly updates with all of our members, so these are very closely tracked. And as you can see, if you came in today thinking the shipping industry is a tough one, I don't like it, people lose their money in shipping, you're not wrong. I mean, over the last 5.5 years on average, the shipping industry has a negative 0.1% return. That's pretty brutal. That's pretty rough. So if you came in here skeptical about shipping, I definitely understand where you're coming from, and you're definitely well informed if you thought that. If you pick small caps, you'd be up about 14.6% annualized over the last 5.5 years. That's a pretty good return. Small caps have done well. But if you look at how we've done in our model portfolios over the last 6 years, we have about a 43% annualized return. Now, again, past performance doesn't really say anything about what we're going to do in the future, but I'm pretty proud of our team and the focus we brought to the markets. So talking about COVID and how did that hit us last year? 2020 was a very tough year for a lot of folks for a lot of reasons, but especially in the markets for shipping. Shipping stocks did not do well whatsoever. Decimation completely across the board. All the shipping stocks crashed in the first half, and there was really no huge recovery trade that we had like in the middle of the year. In March and April, the stocks fell apart, but you could put money in the market in April 2020 and a blind squirrel got his nut, right? Everybody succeeded. Shipping, I wasn't looking so good last August when I came on here talking about shipping stocks. As of mid-December, so basically the end of the year, there was like a final spurt there where they did decently in the last couple of weeks, but mid-December, only 4 out of our 55 stocks we cover were positive. 93% of the industry, of the top industry stocks that we follow, were losers in 2020. Brutal year. And this is kind of a chart that shows you what happened. That everything fell apart in Q1. Shipping was down 50%. Throughout the middle of the year, shipping was flat. You didn't make any money April to August, which was brutal because everybody around you was crushing the market. And then the last part of the year, shipping did okay. It started to outperform a little bit, 18%, so a little bit alpha. It wasn't until 2021 that the stocks took off. And why did these lag? Why was 2020 such a bad year? We want to learn from it. We don't want to just complain about it and make excuses. So we have to look into why the stocks did poorly. Well, first of all, they screened terribly. They were value stocks. People hated value back then. Small caps, again, during a pandemic, you really want to get into small caps. International, there was a lot of shutdown travel and trade flows were of a concern. Commodities were down in 2020. There was a higher leverage on some of these balance sheets. You don't want that during a pandemic. And finally, there was China exposure. Right? There's a lot of concern of how COVID would impact China's recovery and their trade with the rest of the world. Most shipping investors are deep value oriented as well. So looking at this sort of thing and coming into a market where COVID's crushing everything, a lot of value investors didn't really want to get into this stuff at that time. Finally, I'm sure a lot of you have had questions or skepticism about the corporate governance in shipping. That was a problem in the past, especially about a decade ago. But there's been a lot of reforms, and a lot of the crappier, smaller cap companies, if they have really bad governance, we don't even cover them. There's a couple of them that we do cover with like caveats, heavy caveats and highlighting. But most of the firms that we cover in our top picks and our recommendations have very high corporate governance, well above average. Looking at the transit point between 2020 and 2021, a very tough year followed by a very profitable year, we want to learn from that as well. How did that change? Why is the cycle more attractive to folks now? Well, the first part is that value investors are back in the market. Value is suddenly on trend again. Value had a very brutal decade, but I used to be, last year or two, I'd go talk to folks and say I'm a value investor, and their eyes would glaze over, right? They'd want to go talk to anybody else. This year, value is a little bit more back in vogue, and folks are starting to look at some of the fundamentals in shipping and finding stuff that they like. That's helped when we have surging cash flows and strong reports. The balance sheets of these companies are the best that I've ever seen them, certainly the strongest in the last decade. And we expect a lot of dividends, a lot of repurchases to start flowing through across the industry. Finally, and this was more earlier in the year that this was a hot trade, but inflation, or some people call it reflation, became kind of a focus item for folks. And that's kind of an extension of this global commodity boom where we had basically everything was up. But right now, it's not so much the stuff like lumber and maybe like iron ore that was hot earlier. Now it's mostly energy, but we're still getting that overall global commodity boom and trade focus. Shipping, in my opinion, is a phenomenal inflation hedge. I think it's one of the best places to be if you expect inflation. Not only do your asset values, your ship values rise with inflation because they're real assets, mostly made of steel, but you also have day rate increases, right? Because just the inflation alone is going to cause you to get more money per day for leasing out those ships. Finally, if you have fixed cost debts, those go down with inflation, or at least the real value goes down. So you have assets going up, debts coming down, and you just get an explosive impact to your net asset value and your earnings per share potential. I'm not personally on the hyperinflation train or like this new normal type of thing, but I'm also not on the page that this is all transitory, right? I think the proof is somewhere in the reality is probably somewhere in the middle between those two extremes. And I think shipping is just an excellent place to be. Even if inflation does surprise to the high, I think we're going to do very well with these picks. So year to date, I kind of already showed you by suggesting how the picks did, but here's a chart that kind of talks about how our models have done year to date and tracks the industry. So performance year to date, our speculative model is up 179.1% year to date. I updated those numbers this morning right before I came on here. And the risk reward, that's taking a little bit more of a conservative approach to the market. I don't like to mix the words too much conservative and shipping because it is volatile. This is a cyclical industry, but we do pick companies that have very strong balance sheets, strong corporate governance, are not as exposed to spot rates. Obviously, when rates are going up, you do want that exposure. So it makes sense that in a very favorable market, our speculative model would outperform. Here's a chart of that shows this year to date, how we've done. You can see there's been a little bit of fits and spurts, a little bit of a pullback into the summer. And then we had a little bit of a pullback the last couple of weeks. We had some concerns about China and the Evergrande situation. There's also some very misleading reports coming out about container ships. There's a lot of politicians grandstanding on this supply chain crisis that are kind of speaking out of turn on how things are going. And I think that caused investors to be a little cautious. So we had a little pullback. As you can see, we're starting to break out again, a significant breakout over the last couple of days. So today, that's kind of the overview, the sector, what we do. We're going to commit about another 10 minutes into the sectors, and then we'll open it up for questions. So starting off with containers, this is a story of global restocking phase versus logistics bottlenecks. As you've probably seen some of the charts and you've seen enhanced consumer spending over the last couple of years, the global inventories, especially in the United States, have drawn down well below their normal levels. At the same time, we have logistics bottlenecks at every turn. One of the misnomers is that the bottlenecks are only the ships getting congested, that it's only like the LA and Long Beach ports, or it's only Chinese exports due to COVID. The reality is that every single portion of the supply chain is congested. There's 10 or 11 things you can point to. One other, for example, is the lack of warehouse space outside the LA ports and other ports across the United States, the lack of available truck chassis to hook up these containers, the lack of available truck drivers in the United States. So I just listed 4 things right there that it's a lot more than just ships piled up on the coast. The best part of this is that if you think about shipping rates, it's all about supply and demand, like any other market, but shipping is very cyclical. So you want to look at what the future supply looks like. Well, the order book is very limited until the middle of 2023. That's because you have to order these vessels about 3 years in advance. And back in 2020, nobody was buying ships. They didn't really start buying new container ships until early this year. And by the time they started buying them, they were already 2 or 3 years late because there was also a decade-long downturn before COVID even. So people weren't really excited about investing in shipping, as you can understand. So we don't see any of this new supply really hitting the market until 2023. The actual supply growth next year in 2022 is smaller than the growth we had this year and smaller than the growth we had last year, which is really crazy when you think about it. The market's getting better and better and the supply growth is getting lower and lower. In a market like, in a more responsive market like lumber or timber, you don't see a 3-year lag like that. So we're pretty excited about this. And I mentioned the additional like bottlenecks across the chain. It's just, I call it fuel to the fire. I mean, it's like the politicians, or the people in charge will scramble to one thing and try to fix it. You've probably seen some of these headlines about 24/7 operations at LA Long Beach. Well, firstly, that's a decade overdue. It's crazy that we have a top 20 global port and it's not 24/7. But secondly, even after the headlines and several weeks, the reality is the port's not even open 24/7. I mean, the lights might be on, but they don't even have the staffing or the capacity to run that. And again, as mentioned, that's 1 out of like 10 steps until it ends up in your local stores. So these average container ship rates, due to this phenomenal setup, they're at all-time record highs and they've been there for 4 months straight. Now, are those rates going to stay there forever? No, not at all. In fact, I think the rates are probably topping out and the leasing rates are probably going to start coming down in a little bit, but we don't really care because our companies have signed fixed contracts for 3 to 5 years on a lot of their fleet. Now, granted, they have some rolls that are coming up in 22 and 23. They're going to work through those, but just the ones they've already signed in the last year of uptick is enough to guarantee strong free cash flow for basically until the middle of this decade. So our top pick in containers is Global Ship Lease, GSL. We have a fair value estimate of $45 on this stock. And right now, I believe it trades around 24. So significant upside is what we see there. Some other companies for you to consider. We got Atlas Corp, Costa Mare, Danaos Corp, and Zim. I should have mentioned this at the start, but nothing you hear during this presentation is investment advice or recommendations of any form. I'm just sharing my research and my opinions on these stocks. I have long positions and exposure to several of the names we will cover today, including all of our top picks. And I'd hope you'd expect me to have a position in my top picks. If I was telling you that these were the best stocks and I didn't own them, why would you listen to me, right? So in the container ship sector, one of the big trends that we enjoy is a strong consolidation across the global liners. The top 5 firms now control 65% of the market. The top 10 control 85%. This is very similar to the consolidation in US airlines. Remember how airlines were a terrible business for 50 or 60 years? I think Warren Buffett had a controversial quote about how it would have been great for capitalism if the Wright brothers were shot. He said something like that, a pretty controversial quote. But in terms of economics, not incorrect. Airlines were a terrible business. Well, container ship liners were also a terrible business for 20, 30 years. There was this rampant competition, and we're in the exact opposite now. We're in a consolidation phase, and it gets every couple of times I give this presentation, because I've been doing this for a couple of years. Every time I give the presentation, I feel like it's up 1% or 2%. I think it was at like 59% when I started doing these. This is the 1-year container ship leasing rates. This is a 2-year chart of the 1-year rates. So when you lease a container ship vessel, it's an equipment. So usually you want a longer term on it. As you can see, the bottom of this index was about 500. That's not an actual dollar value, that's an index number, but you can see now it's at 4,000. So it's up 8 times from its lows. And this is a 20-year chart of the index. And as you can see, we're at a massive spike right now. You can see it's starting to crest. It's starting to come over there, and it's probably going to form almost like a parabola. We would expect it to come down here in the coming months. And that's fine. That's in line with our base case analysis. I think anyone that tells you that this rate's going to keep spiking, or it's going to stay here for 5 years or something, I don't think you want to listen to someone like that. I think they're probably selling you something weird. We think it's going to come down. Everybody should expect it's going to come down. But our point of view is that it doesn't matter, because our companies are locking in these long-term contracts. Here's the average shipping freight rates. These are the rates that the actual liner companies themselves are getting with their customers. There was some bogus report out a couple of weeks ago that said Chinese rates were dropping by 50% overnight. First of all, they dropped about 12%. You can see the drop here. And second of all, China just had a week-long national holiday. China takes the entire week off. They close almost everything down. Ports are closed, warehouses are closed, workers do not show up to manufacture. It's a national holiday. So that's basically what happened here. And as you can see, they took the national holiday 10 to 15% down, and the rates are already starting to come back up. So there's a lot of bogus stuff floating around. I think Zero Hedge had some weird piece on that. So our next sector we want to talk about is dry bulk. That's all about the global infrastructure surge and a really, really small order book. We love it when there's no future supply. So as you know, we're doing a kind of a global reopening step by step as we work our way through COVID. Lots of countries are focusing on infrastructure. United States has been key, the political debates on what we're going to spend, how many bridges, highways, new ports, things like that. This is all across Europe. We're going to expect these infrastructure developments. Also across Asia, China is continuing to heavily invest in their infrastructure. So that's going to lead to a lot of demand for iron, cement, stuff like that. Also, climate change initiatives. You usually don't think dry bulk and climate change go hand in hand, but a lot of that stuff that's required for those initiatives are going to require copper, bauxite, more cement, stuff like that. So we're pretty bullish on that. Finally, the dry bulk sector has the lowest order book. Really the lowest order book in modern history. Lowest I've seen, I think it's the lowest in like 29 years or something like that. Finally, I said finally already, but a little factor that's helping us out is there's increased tensions between China and Australia. And that's caused a global rerouting of a lot of coal supplies. It's been a nice little bonus to us, helping keep the rates a little bit higher yet. Our top pick in dry bulk is focused on the mid-size vessels. Everyone always talks about the large ones, the Cape sizes, but we really like the mid-size because the rates are steady and stable, and no one's really looking at it yet. It's Eagle Bulk, EGLE. If you pull up a 6-month chart of that stock, you'll see that it's been consolidating for 6 months, hasn't moved. But if you look at the dry bulk rates, you'll see that they're going higher and higher and higher on a steady basis. Very low volatility, very high grinding upwards. The stock hasn't moved. We think it's going to break out soon. Other firms we follow in dry bulk, Genco, Golden Ocean, Navios Partners, and Star Bulk Carriers. The market is extremely strong right now. This is, in my opinion, a result of market imbalances that have been going on for a while, as well as that Cold War rerouting that I talked about with China and Australia. We think the global demand surge could last through at least 2025, as the global focus is on infrastructure and climate change. If there's really, really heavy focus on new climate change infrastructure, then that might last even further yet. 90%, and I say 90%, but basically everybody's focus is on these volatile Capesize rates. They're the largest ships, but they carry primarily iron ore from Brazil, to China and from Australia to China, a little bit of coal. So focus is on these Capesize rates, and they bounce all over the place, up and down, up and down, up and down. And that's how they always are, super, super volatile. The actual point, in our opinion, to focus on is the mid-size rates. Those have been grinding up steadily all year long. Almost no seasonality, almost no volatility, just higher and higher and higher. And that's why we like that company, Eagle Bulk. But we really think folks get too distracted on Capesize rates. We'll see the rates go up really big, and there's all these headlines about spiking rates. And then we'll see the Capesize rates pull back, and everyone says rates are crashing. Just cut through the noise. Look at the mid-size rates, and you'll really see how strong this market is. Here's the Baltic Dry Index. The Baltic Dry Index is a size-weighted index, so it's very heavily focused on those Capesize. Larger ships, most volatile, make up a large portion of this index. You can see there's been some fits and spurts. This is a 5-year chart. There's been some fits and spurts this year, but the longer term trend is pretty clear here. There's been a pullback in accordance with the Chinese National Holiday Week. Also, China is trying to put in some pollution controls. They're trying to reduce their iron ore imports and steel production ahead of the winter. They're trying to clean things up for the Olympics. That's going to be a little bit of a near-term headwind, but at the same time, China is desperately low on coal. India is desperately low on coal, and there's a global energy crisis ongoing. So we expect that the coal is going to help balance a lot of that out. We're going to see some volatility in the BDI for sure. I mean, it's very heavily weighted on capes. We wouldn't be surprised if this keeps bouncing around. Could flatten out and trend down a little bit. But if we keep looking at those mid-size rates, I think investors will be very happy. Our next sector to talk about is tankers. So containers have kind of already moved, but they're still interesting in our opinion. Dry bulk has been consolidating, slowly grinding higher. Tankers are a tough sector to be into. They're deep value, the recovery potential. It's about what might happen next year. Crude tankers got slammed by COVID-19. The other sectors, I mean, all the stocks dropped, but the rates didn't drop. In tankers, they did really, really well for about 2 months on that floating storage trade. And ever since then, they've been very, very dismal. The market is showing signs of recovery, but it's slower than we previously expected. And we don't really expect to see normalization until mid to late next year. Some of the stocks are starting to move on some optimism. But one of our favorite picks is a stock that's been flat for a year straight. It's actually down since last year. And investors don't seem to be too excited about it yet. They just completed a major transformative merger. I think maybe some of the folks that came along from the old merger don't really understand the new company. So there's a little bit of overhang there. As we start to work through that, I expect this to be a major breakout once tankers start moving upwards. That top pick is International Seaways, INSW. Their net asset value. It's like book value in shipping, but it's if you sold all your ships and paid off your debts, what would the stock be worth? Their net asset value is about $30, and they trade, I believe they traded 18 today. So it's just a remarkable deep value pick. I'm not saying it's going to break out next week, next month, but if you have a little bit longer term horizon, you consider yourself an investor, International Seaways is one of the best there is. Other firms out there, there's DHT Holdings, Euronav Frontline, Scorpio Tankers, and TK. There's also a few others, but these are some of the bigger ones that we cover. In tankers, the big story here is that the order book is at a 20-year low. You catching the trend? The order books are small across the board. When you get burned in shipping for 10 years, you don't want to plow a lot of money into it. So we've had a 5 or 6 year period of underinvestment rampant across almost every space. But this one as well, tankers, 20-year low order book. Meanwhile, the fleet supply is the oldest it's been in over 20 years. I took this slide from Euronav here, but you can see the red container on the left shows the ships that are expected to be scrapped within the upcoming months. The only reason they're still on the water is because they're doing sanctions trades with Venezuela and North Korea and some sketchy stuff. Once that enforcement picks up a little bit, which we expect it will, those ships are going to be gone. And then the ships in the yellow are the ships that are basically borderline obsolete. As these new environmental regulations start coming on, starting in 2023, it's going to be very difficult for these ships to compete. So we expect those ships to be forced out of the water as well. So we have the lowest order book in 25 years. We have the lowest fleet balance in 20 years. It's a pretty fantastic supply setup. Finally, I want to talk about LNG. That's kind of the exciting one right now. LNG rates have been exploding over the last 2 weeks. That shouldn't be surprising if you've been following the global energy crisis. But this is a kind of a corner of the market that I think folks are just starting to figure out. So we had a little bit of a boom and bust in LNG the last couple of years. A lot of folks got burned out by the sector. Maybe didn't understand how seasonal it was. So we had a kind of a up and down in some of these segments. But the exciting thing about the LNG shipping markets is there's an almost guaranteed growth upcoming for the next 5 to 10 years. Yes, LNG is not super exciting to climate change purists and stuff like that. They haven't really embraced it as a transitional bridge fuel. But if you think about the requirements to boost the power grid outputs to support electric vehicles, If you think about the forced retirement of coal power plants, there's really no way to get there without massive investment in global natural gas power production. The only way to efficiently transport that across most of the routes is via ocean and via these LNG ships. So we're pretty excited about it. Finally, there's a lot of technology bifurcation, really a trifurcation. There's 3 tiers of these ships. And the most modern ones can outperform by over $20,000 a day compared to the oldest ones. So we like the firms that have some of the newer and nicer ships. Our top pick in LNG is actually a play that doesn't only do shipping. They also do the natural gas offshore production. So you're getting a little bit of both worlds there. And with the current natural gas markets and the futures curves and everything we're seeing, we expect some of this offshore stranded gas development is going to be a really hot play in the next 5 to 10 years. So that's Golar LNG, GLNG. It hasn't taken off quite yet. It hasn't taken off as much as some of the other LNG names. And the 2 other picks in the sector, the 2 names we follow are Flex, FLNG, and Gaslog Partners, GLOP. Flex was actually our top pick at a previous money show seminar. So if you've been coming to these, you might recognize it. If you pull up a chart of FLNG, you'll see it has done phenomenally for us. We were in about $4.50, $5 last summer. I believe it trades around 20, 21 right now. And not currently our top pick. Our top pick is Golar, but Flex is a phenomenal firm and just shows you what can happen when you get ahead of these curves. For LNG, the major driving factor is U.S. natural gas exports. This chart shows that U.S. natural gas exports since 2016, actually 2014, but you can see in 2016 it started to move upwards on a steady slope, interrupted by COVID, and then now we're rapidly back on that trend line. This data is actually about 3 months delayed. This is a July data point here. I believe that when we start seeing the November and December export levels, we're going to be up to almost 400,000 level, which is 400,000 million cubic feet. So it's a significant amount of LNG the US is pushing out. Why is it so bullish, right, that the US is pushing all this LNG out? Well, United States, specifically the Gulf Coast, which is where most of this comes from, to China, which is the major importer, Japan, major importer, Korea, major importer. Those are some of the longest shipping trade routes in the world. So it's a lot closer for the Middle East to be selling their natural gas to Asia than it is for the United States. But where's all the growth coming from? It's all coming from here, or the Southeast of the United States. So it's a phenomenal story for the shipping. If we get like a 6% growth in demand for the end product, we can see it from a 6% growth of demand, we can see 12, 13, 14% shipping demand. So it scales up very, very nicely. Finally, there's clear seasonality in LNG shipping rates. This little spike from here to the green X is 1 week. These are the rates as of last Friday. And you can see every year it's seasonal, but look how early we are. This is like November, this is October, this is January, and we're still mid-October and we've already outperformed the last time it was in October. It outperformed every October significantly. We're 2 months ahead of the curve. So we think this could go significantly higher. Can't make predictions, it's always a guess, but I think we could possibly see all-time record highs in the coming months. Finally, very last point here, there's a massive arbitrage, moving that gas from the United States at Henry Hub over to Asia. This is the January 2022 futures contract. Last time I talked to Money Show, we talked LNG. I said the arbitrage is amazing, it's only going higher. That was at $14. Now it's at about 35 in Asia. They're getting it off Henry Hub for 450. So they're pressurizing it, paying a couple bucks for shipping, paying a couple dollars to liquefy it. They're making mega arbitrage. So those shipping rates, if it's $35 from here and Henry Hub is in the 4s or 5s, the shipping rates could be over $500,000 a day. The economics are phenomenal. So to wrap everything up, I know I'm running short on time. We'll try to get at least a couple questions in. Containerships top pick is Global Ship Lease. Dry bulk top pick is Eagle Bulk. Tankers, we like International Seaways. LNG, we really like Golar here. And then finally, overall top value selection, it wasn't included in the segments, is Zim Integrated Shipping. We expect earnings per share of $10 to $12 in Q3. That's in a single quarter. It's already happened, but it's going to be reported probably early to mid-November. We expect 11 to 15 in Q4. So if you look at that, that's like $21 to $27 in 2 quarters, half a year. The stock trades at like 45, 46 bucks. It's net debt free. There's really no serious balance sheet concerns here. We estimate there's currently about $20 of net cash sitting at Zim. They're going to earn 100 to 150 million in free cash flow, not operating cash flow, free cash flow per week at current rates. That's over $1 per share this company is earning per week at these rates. The stock trades at like something ridiculous. I mean, it's like, I think it was 45 or 46 last time I looked. Our fair value estimate is 70 bucks. I think that's extremely, I think we're really sandbagging this one at 70, but I'm trying to be careful, right? Freight rates are volatile. I don't want to overpromise. So I prefer to underpromise and overdeliver. We expect that one's worth at least $70. They're going to report earnings in a couple of weeks, and we think that's a game changer for them. So that's my information again. You can follow me at Twitter at Mintzmeyer. We have 2-week free trials available at mintzmeyer.com. I think we might have time for one question. I apologize for running over a little bit.
Fantastic presentation, Jay. Can you hear me okay?
Yeah, I can hear you just fine.
We've got time for maybe just one question. One of our viewers writes in, dry bulk and container stocks are ridiculously cheap, 30 to 50% of NAV, 1 to 6x EPS. Balance sheets are fantastic, record chart lengths, and they are deflation hedge and dividend CF are gushing. Why is the disconnect, and what changes this undervaluation? Do you think these stocks get crushed as charter rates start to normalize?
Yeah, that's a phenomenal question. You teed it up very nicely by laying out all the positives. And it's like, what's going on here? What's the disconnect? What's going on? What's the puzzle? One of the things that's really been punishing dry bulk stocks is this Evergrande credit situation in China. A lot of folks are looking at that and they're saying this is the next Lehman moment. This is going to bring the entire country down. Now, if you believe that, if you believe that China can't even handle a developer, right? It could happen. I'm not saying it can't, but if you believe that, then it makes sense that you don't like dry bulk. I wouldn't like dry bulk if I believed that that event would take down the entire country. Now, if you believe that China can handle it, just like we handled our own crisis, right? Global financial crisis, we let that thing run amok for like a year before the government stepped in with stimulus and TARP. China's addressing it immediately. So they're well ahead of how we handled it. And we handled it just fine in the long term. But if you think they can't, if you think it's a Lehman moment, then that might explain some of the dry bulk stuff. With container ships, we think the pullback was mostly due to completely misleading false reports that were coming out of China about crashing rates. It was really sketchy, actually, some of the reports that were coming out. They weren't backed by any of the data. Like we were looking at, we have the Freightos, we have the Shanghai composite rates. We were pulling up all our data and we couldn't figure out who was making these claims. They haven't been borne out by data, but we think that's held those stocks back. I think once we get in the next couple of weeks and the earnings start coming out and people start realizing, wow, these companies are delivering, we think that's going to make the difference and lead things to break out. I know we ran over time. We can't take more questions. Hit me up on Twitter and I'll be happy to answer some of the questions there.
Thanks, Jay. Fantastic presentation. We really appreciate your time. And the Longtime Speaker Money Show, we appreciate you as always. Thanks so much for joining us today.
Thank you.